It has been quite an eventful month for Mexico, both politically and economically. So joining me down the line to discuss the possible implications is Dr. Bernd Berg from Credit Suisse. Bernd, the outcome of the recent state election has been deemed as positive for the reform agenda, and some analysts believe the economy is likely to benefit from the positive growth trend in the USA. Last year, the economy grew a healthy 3.9%, but slowing exports and an increasing budget deficit has hindered the outlook for this year. The GDP figures are expected on August 20th, but what sort of number would you say the indicators are pointing towards?
We believe that GDP will be expanding by around 2%, possibly a little bit above 2% year over year in the second quarter of 2013. We think that the soft patch in Mexico that we have seen recently in terms of exports, in terms of industrial production is coming to an end. We think over the second half of 2013, the Mexican economy should be supported by the stronger numbers in the U.S. Today we saw that second quarter GDP in the U.S. annualized came out at 1.7%, significantly above the 1.0% expectation. So we think that the Mexican growth rates should be supported by stronger growth in the U.S., also by the stronger housing market. So we really expect a pickup in growth in the Mexican economy, also supported by the reform agenda of the government. We think that in the second half of the year they would pass the bill for the energy overhaul and tax policies to Congress, and we also expect an approval at the end of the year, which is also positive for the long-term prospect for Mexico.
Since May, the Mexican peso has lost some 6%, mainly due to a Fed-infused unwinding of long positions in the Mexican fixed income and FX markets. Do you think this trend is likely to continue, or is a readjustment of positioning on the cards?
I believe that the main driver of the recent losses on the Mexican peso have been the volatility in the U.S. Treasury market. You could see that the 10-year U.S. Treasury yields have jumped from 1.7% in April to 2.7% as we speak. So there's a Fed tapering concerns in the market, which has resulted in this volatility in the rates market. And a lot of foreigners have also sold fixed income positions in emerging markets, and especially in Mexico. You could see that also Mexican yields have jumped significantly to the upside, and in line with this selling pressure on emerging market assets in general, you could see that long positions in Mexican peso have been reduced over the last 2 months, and we think it's more like a technical reaction to the rise in yields in the U.S., but from a fundamental perspective, we think after this panic selling and reduction of long positions in the Mexican peso that there will be renewed buying interest, and we expect that the Mexican peso should reappreciate over the next couple of months.
You mentioned bond yields. Mexican bond markets have suffered major declines as investors withdraw assets from markets and asset classes with close proximity to rising US yields. But what do you think we can expect in terms of Mexican bonds in the months to continue?
I think it's definitely correlated to the developments in the U.S. We believe that the main rise in yields, also U.S. yields, should be over for now. The Fed has announced it's focusing on reducing volatility in the Treasury yield market. The Fed doesn't want unintended volatility, which would basically also hurt the growth prospects for the U.S. economy. As you could also see that mortgage yields in the U.S. jumped significantly 30-year towards 4%. So the central bank is focused on keeping volatility under control and not letting yields jump immediately, let's say to 3.5% or above 3%. So we would expect that volatility comes down in the US, and because of the correlation also in Mexico, that we see potentially, as we see stronger U.S. Economic data, we can see yields going up a little bit more and potentially towards 3% in the U.S., and also then Mexico would follow. But generally speaking, in the months to come, also the Mexican yields we would think in a range around current levels.
And taking everything that we have discussed so far into consideration, what is your outlook for the Mexican peso for the next 6 to 12 months?
Our forecast is that the Mexican peso would appreciate to 11.70. So we expect a significant appreciation of the Mexican peso. It's our top pick in emerging markets, while acknowledging that emerging markets in general are in a soft patch, looking especially at the BRIC nations, China, Russia, India and Brazil. They are experiencing a temporary or basically some kind of structural downward drift in growth rates, which is hurting emerging market growth momentum globally. And also we see some countries which are experiencing country-specific issues, talking about South Africa, where growth is very weak. You have mining strikes. Talking about Turkey, where you have the protests and a twin deficit, for example, in India, with the current account deficit significantly rising. So some emerging markets have some specific problems, but Mexico we really like in terms of fundamentals. We think domestic fundamentals are strong. The economy is on a good track also to outperform Brazil and other Latin American countries. The driver there we see is the U.S. Growth, which will boost the Mexican growth rates also. So Mexico is our topic, and we really expect that the peso could appreciate towards 11.70 over 12 months.
Berg, thank you so much for your perspective today. Well, that's all from me for just now, but click back to Dukascopy TV for an economic update on Zimbabwe with my colleague Darren McDermott. Goodbye for now.